Start. Okay. Good morning, learners. Today we shall be looking at ledgers and double entry aspects. We shall be borrowing a leaf from what we did from previous lessons. So when we talk of a ledger is a T account, a capital T account. And this ledger has two sides. One on the left hand side, it's called the debit side. Debit side. And we usually use DR to represent the debit. And on the credit side, on the right hand side, we have the credit. It's called the credit side, which we usually CR to represent that particular side. So for this ledger account, there is usually a title for the account that you are preparing. Like for example, if it is cash, we have the name here, name cash. That is the title of that particular ledger account. Inside the ledger account, there are some details that we usually capture, like the date. The date. This is when the transaction took place. The date with which the transaction took place. Like if it's today, the date today is 29. We record 29 of April there. Then we have particulars. Particulars. At the particular, we record the other affected account. As you shall learn as we progress, ledgers are usually prepared using a double entry aspect, meaning that for every transaction that happens in a business, there are two or more accounts which are affected. So the other affected account is recorded here. Like for example, if you buy a laptop using cash, there are two accounts which have been affected there, laptop and cash. So if this is a cash account, at the particular, we shall record laptop there. Then for every transaction, there is an amount. So these ones, if we had bought the laptop for 50,000, we shall say today is 28th of April. At the particulars, we record a laptop. Here it is a cash account, and then amount is 50,000. The same case, because we say that is a T account, whatever is on the debit side is what is in the credit side. So we can say they are similar on both aspects. Yeah. So when you make an entry on the debit side of a ledger account, we say you have a debit entry. When you make an entry on the credit side, we say we have a credit entry. So that is what ledgers are. And as we said last week, the backbone of every accounting is the bookkeeping equation, and therefore ledgers will also be following the bookkeeping equation. The bookkeeping equation, to remind you, we say that it is asset is equals to capital plus liabilities. So what usually happens when assets increases, we usually debit them. When they decrease, these ones we debit. When they decrease, we usually credit. When capital and liabilities increase, we usually, when they increase, when the upward facing arrow represent increase. So when we say they increase, we usually credit. When they decrease, the downward facing arrow represents decrease. We usually do what? We debit. So that's what we usually have for ledgers. And because we shall, apart from assets, capital and liabilities, these items will be expanded as we shall see later. We shall have items such as sales. We shall have other assets like purchases. We shall have expenses, incomes and others. So to summarize this thing on how we record transactions in a ledger account, we usually come with an acronym whereby we say A, P, E, D, L, I, S, I can call it appendix and C, appendix, So what we usually do, we usually cut it at this particular point, at the center. On the top, we have 1, 2, 3, 4 items, and from the bottom, we have 1, 2, 3, 4 items. So the first item here is assets. The second item is purchases. The other one is expenses. The other one is drawings. The other one is liabilities. The other one is incomes. The other one is sales. And the other one is capital. Higher. So what happens, the upper side of this particular section, when they increase, we usually debit. When they decrease, we usually credit. So that means if assets, purchases, expenses, and drawings increases, we debit. When they decrease, we credit. The same case with this one. Now, the lower part of this case, it is the inverse. Whenever they increase, or this, whenever they increase, we credit. Now the opposite of the above. When they decrease, we debit. We debit. So this is what will be taken as throughout the topic and the other topic that we shall be having. So when you see assets, purchases, expenses, and drawings, anytime they increase, we debit. Anytime they decrease, we credit. Liabilities, whenever they increase, we credit. Incomes, the same. Sales, capital, whenever they increase, we credit. Whenever they decrease, we debit. So that will be our guiding principle as far as ledger preparation is concerned. Let me touch something about double entry aspect. When we talk of double entry aspect, we are saying that for every transaction, we say that there are more than 2 accounts which will be affected. In simple terms, when we talk of ledger, recording in a ledger, it involves giving and receiving. There is an account that will be receiving and there will be an account that will be given. So that's why we are saying that there will be a double entry, giving and receiving. So let's now do a question so that we can understand these ledger transactions. In the note that I've provided you with, there is illustration number 1. Illustration number 1. So we shall go through it very fast. The illustration says that light up assets, capital, and liability accounts in the books of Kitutu to record the following transactions. Let's record the transactions one by one together. Okay, I will have my initials here. A, just like that, so that we'll be referring to them. So this is the initials, the assets, purchases, expenses, drawings, liabilities, incomes, sales, and capital. So the first transactions was June 1st, 2002. We are told that started a business with shillings 50,000 in the bank. started a business. So whenever you are told that someone started a business with some cash, so any amount of money that anybody uses or any asset that anybody uses to start a business with, it's called a capital. So in that particular transaction, there are the first thing that we should do is to identify the two accounts that will be affected there. And the first account that will be affected there is capital, because it's starting a business, and cash in the bank, that is bank account. So we shall start with the first account, that is capital account. Capital account. We say that we usually start with the date. So it is 2002 June. So that's the date. The date is June 1st. At the particulars, so because this is capital account, the other affected account will be bank. This one will be given to bank. Are you together? So the bank will be receiving. So because we say that allegiance is a matter of giving and receiving. So here we shall have the bank, and then the amount involved in this case is 50,000 shillings. So sometimes we don't have to write the date, particulars, and amount. So don't wonder why I've not written these particular ledgers. So any accountant seeing what you've prepared will understand that this is date, details, and amount. So that is a capital. Then because it is dual, it is double entry aspect, there is the other account which is affected, and that is bank account. So here I shall open a bank account. I shall open a bank account. Bank account. Bank account. So for bank is an asset. So bank is increasing. Sorry, I made a mistake here. So this is capital. This is capital, and capital is in the lower quarter. I have confused that one with the bank. So capital is in the lower quantum. So what we do, we shall be crediting it solely for that. So we shall have to credit this one. So the other affected account will be bank, and the amount will be 50,000, like that. For bank, we say that capital is given to the bank, and therefore the bank will be increasing, and bank is an asset. So whenever the asset increases, we usually do what? We usually debit. Don't forget, this is the debit side and this is the credit side. So here we shall have 202 June 1st. The date is the same. So the other affected account here, because it's the same transaction, we shall have it as a capital. So here we shall have capital. The amount still remains the same, 550,000, like that. That is the first transaction. Let's go to the second transaction. The second transaction took place on 2nd June, and we are told that bought motor van paying by check. Bought motor van paying by check. So we say that the first thing to do in this case is to identify the accounts which are being affected. So when someone buys by check, that means the bank is you are affecting a bank account, and the other account that will be affected is you have bought a motor van. So the other affected account will be a motor van account or a motor vehicle account. So we already have bank account, and because we are buying by check, so bank will be giving some cash to the seller, so to the seller of this motor van, and bank is an asset, so assets will be decreasing. So what shall we do? We shall credit. So it's 2002 June, and this is June 2nd. The other affected account here will be motor van, and the amount of that particular transaction, the motor van was bought up for 12,000. So at the amount section, I shall have my 12,000 recorded there. So on the other case, because it's not complete as not having opened another another account, sorry. So we shall have a motor van account. So we shall have it here, motor van account. Motor van account. So this is still debit and this is creditor. So motor van is an asset, and when we buy a motor van, it means that our assets are increasing. So what we usually do, we shall be debiting our motor van account. So the date the year still remains is 2002 June 2nd. Under the particulars, we shall have bank. So here we shall have bank, and the amount of the transaction is 12,000, just like that. So we have recorded the transaction in a double way. That is a double entry. We have entered the transaction twice. So the other transaction is on 5th June. We are told that bought fixtures worth shillings 4,000 on credit from Office Masters Limited. So in this case, he has bought fixtures. Fixtures is an asset. Fixtures is an asset. So we shall come here and open a fixtures account. We shall come here and open a fixtures account. So this one we shall call it fixtures account. Under the fixtures account, fixtures is an asset, so they have increased. So them have been increased. So we shall be doing what? We shall be debiting that particular transactions. So 202 June 5th. The date there is June 5th. And the other account here is he bought by credit. So, and the credit, and in this case, we have created someone called a creditor. A creditor is someone who has sold to you an asset on creditor, so that you will pay him or her later. So we shall record the name of the creditor here because it's given, and the name of the creditor is Office Masters. Office Masters. For that transaction, Office Masters. For that transaction, they had the amount is 4,000. So that's how we record that. That is the first part of that particular transaction. Then we have to record for double entry. We have to open another account for Office Master, and Office Masters here is a creditor, and creditors are liabilities. These are people who we owe them, so we have an obligation to pay them. So we shall open an account here called Office Masters account, and you can note somewhere that these are creditors. They are creditors. The side still remains the same. This side is debit, this one is creditor. Yes, so let me, because of the space, let me highlight this one. This one was 12,000, like that. So this is a creditor. Creditor is a liability. A creditor is a liability, and liabilities have increased. When the liabilities increase, we say that we shall be crediting. So in this case, it's the year is the same, and June 5th. The other account affected here, we shall have fixtures, and the amount of the transaction is 4,000. You record them just like that. And if you are keen with how we are recording these transactions, for every debit there is a corresponding credit. That's how simple it is for double entry. For every debit that you are making, there is a credit entry that you are making on the other case. The other transaction is on 8th. Bought a motor van on credit from Motor Cars Limited for shillings 8,000. We already have motor van, and we've bought it from on credit. So we shall not open another Motovan account. So because we still have a Motovan account that is existing, we shall still use the one that is there. So we shall have the transaction recorded here. It is 8th of June. So we bought it on credit. So we have created another creditor called Motovan. So here we shall have Motovan as the creditor there. And then the amount of the transaction in this particular case is 8,000. 8,000. Sorry, they are called Motovan, Motocars, not Motocars Limited. That is the name of the creditors, Motocars Limited. So we shall open a creditor's account known as Motocars Limited. So here we shall have an account here, Motocars Limited account. So the account will be like that. So because this is a creditor, still is a creditor, and a creditor is a liability. Liabilities, when they increase, what do? We credit. So this is still the debit side, this is the credit side. So we shall record it on this side. So this is the year still remains. This is June 8th. So what we shall do at the particulars, we shall have Motovan as the other affected account, and then the amount here will be 8,000. The amount will be 8,000 there. So we have recorded that transaction. The other transaction that took place was on 12th, and you are told that took shillings 1,000 out of bank to put it into cash till. So this particular person took some cash from the bank and placed it in cash till. So he took some cash, so the affected accounts there will be bank and cash. So already we have bank account, and bank account is losing some cash to cash account. So a bank is an asset, and assets, when the assets are decreasing, we say that we are crediting. So we shall come here and record June 15th. The other affected account is cash. The amount of money that we withdrew from the bank was 1,000. So I will record my 1,000 there. Then, because we don't have a cash account, we shall open a cash account here. We shall open a cash account here. Cash account. And this is the credit. And this is the debit. So, for this case, we shall say that cash has increased. Cash is an asset still, and it has increased. So because it has increased, what do? We debit the transaction. So this is still, the year is 2002, and this is June. It is June what? June 12. The other affected account is bank. How much? 1,000. The amount of the transaction is 1,000. You record it there. Then the other transaction is on 15th. On 15th, we are told that bought fixtures paid by cash, 1,600 shillings. So bought fixtures by cash, 1,600 paid by cash. So in this case, fixtures will be increasing. Fixtures is an asset, and whenever assets are increasing, what do? We debit. So here the date of the transaction is when? The date of the transaction is 15th. So we shall have on 15th. The other affected account here will be cash. So how much? 600. Cash is giving out some money.